In this video, we'll deep dive into the couple of seconds between an inserted credit card and the approval, and look at the technology, the key stakeholders, and the business models behind this relatively complex network. As usual, we'll have 4 parties involved: the paying consumer, the receiving merchant, and their banks. We're going to have a slightly different parlance for these banks, and we'll call the consumer's bank the issuer because they issue the credit card and the underlying loan. The merchant's bank is called the acquirer, and that's where the merchant has their bank accounts to receive money. And in the middle, as usual, we'll have an electronic communications network. And we'll use Visa as the example. So, the consumer first applies for a revolving line of credit from the bank. And once approved, the bank will issue them a credit card that has their credit account information, that is, the card number and the expiration date, printed on the card and embedded in the chip and the magnetic stripe. Now, the consumer takes it to a store and swipe it, say, to buy $100 worth of stuff. In order to do that, we're going to need an additional 6th party involved, called the processors. They're the providers of the terminal, the hardware, and the software to capture the card information and send it onward to the card network. They can be either affiliated with incumbent financial institutions, or they can be fintech startups acting as independent sales organizations, or ISOs. So, swiping or inserting the card itself simply sends the account information, combined with the payment amount information by the processor's hardware and software, encrypt it, and forward it to the network like a text message. The network itself then simply forwards the message to the issuer. Different than an ACH network, there's no batch processing here, and every message is routed through in real time, just like a cell phone network. Once the information gets to the issuer, it'll perform several key intermediation tasks in quick succession. They're going to verify that the consumer has the account, the charge does not exceed the amount of the available loan, and do a quick risk assessment about how likely this transaction might be fraudulent. More on this later. Once everything checks out, the issuer will send an approval message, which will again be routed through the card network to the merchant, showing up as approved on the processing device and maybe printing a receipt. All of this are highly automated and would happen within a couple of seconds. Then, the consumer conveniently takes the product home, and their business with the merchant is concluded. As usual, this is only half of the picture. As settlement, the actual money flow happens later, on other rails, either ACH or bank wire. But wait a minute, each party has to be compensated for making this convenience happen. So instead of transferring the full $100 to the merchants, each party will take their slice of this pie. We'll have a deeper look at how the pie is divided, but for now, note that the issuer will take the biggest piece of the pie for their intermediation tasks. Their compensation is called the interchange fee and could range up to 2 to 3% depending on the bank. In this example, we're using a 2.15% interchange fee, so the issuer will keep $2.15 for the compensation and transfer only $97.85 to the merchant's bank. The acquirer will also take a cut here, 0.15% or 15 basis points as the acquiring fee for simply having the merchant's bank account there to receive money. And just like a cell phone company charging for each call or message, the network itself will have an assessment for this communication, charging in this example 15 basis points. And finally, for providing the hardware and software to accept the credit card and process the transaction information, the processors will charge a processing fee, in this case 5 basis points. So, if you sum this all up, the merchant is getting far less than the full $100. In this example, after 4 parties taking their cuts, only $97.50 is transferred to the merchant's account, leaving 2.5% as the total transaction cost. This is a business cost for the merchants to accept credit cards. So eventually, either they will pass them on to the consumers, either directly as a credit card surcharge or indirectly in their prices. Or smaller merchants won't even be able to afford it, so they won't take credit cards. And the settlement process is not over yet because the loan has to be repaid. The bank will send the customer a bill at the end of the billing period, and the customer then chooses to either pay back immediately, pay later with an interest rate charge, or to default on this loan. But this process is completely between the issuer and the consumer and is decoupled from the actual transaction. Now that you know how the system works, let's take a closer look at the business models for each party involved. Starting with the networks themselves, like Visa or MasterCard. You can see they really operate like cell phone companies. They're the operator of the communication infrastructure. And because all the communications here have to happen in real time, they need to invest a ton of money upfront to build this network, make it robust and scalable, and secure against cyber attacks. Therefore, the fixed costs involved to becoming a credit card network is incredibly high. And just like it's difficult to build a new cell phone network, the barriers of entry to becoming a credit card network is very high. Their primary competitors are the issuer network hybrids that owns both, like American Express. But once the network is built, the marginal cost of processing an additional transaction is minimal. The Visa network, for example, can easily be scaled up to process more than 65,000 transactions per second. So, card networks really have a high fixed cost, low marginal cost business model, making entry by new players very difficult. They also set the overall fee structure for transactions and negotiate the division between parties. But because they're simply providing the communications, they don't get the biggest piece of the pie. The division of the fee would really depend on the risk exposure of each party in this transaction. So let's think about it. Who's taking on the biggest financial risk in a credit card transaction? The issuers. Because ultimately, it's their money at stake. First, by extending a loan to a customer, they always run the risk of the customer defaulting on the loan and not paying it back. Second, if something goes wrong in the transaction, say the credit card was actually stolen or some fraud is involved, then usually customers are not liable, and it's the issuer's money that's lost. So by far, issuers bear the most risks from a credit card transaction. And consequently, they're taking the bulk of their processing fee to compensate for their intermediation services like authentication and risk management services. Now, the merchant's bank, the acquirer, isn't really doing much. The merchant holds their account there, and by transferring the funds to and from these accounts, the acquirer gets a small piece of the pie, usually no more than 25 basis points. And finally, the processors are the hardware and software providers to the merchants. They're not really financial institutions, and they're not taking on any financial risk in a transaction. They provide the machinery, and it's up to the users to use them. Consequently, they take the last and usually the smallest piece of the pie. As you can now see, because they can really compete on technology rather than financial risk-taking, this is the area most fintech providers in the credit card space, from PayPal to Square to Stripe, compete in. They compete as independent payment processors.